Well, welcome to the road less traveled. I want to discuss today why Tesla stock is going to continue to absolutely get obliterated. We're going to be talking about Warren Buffett, one new stock that he bought, a dividend stock that I think is an absolute gem that's going to crush it in 2023 and is probably a buying opportunity of an absolute lifetime. And we're going to be breaking down the historical PE ratios of some of these tech giants just to see if these are true buying opportunities, because some of them are trading at lows they haven't seen since literally 2014, which is just staggering to consider. But let's get into this by saying, first and foremost, the kind of recession I think we're going to see coming into 2023, after kind of really searching deep down into my soul, listening to all these different figurehead billionaires discuss that this could be like a 2009 financial crisis. I don't think it's going to be like that because they tightened up restrictions on mortgages and so many things around real estate. I think overhyped real estate markets are going to see a correction, but outside of that, I think we're going to see the same kind of correction in the stock market, and we already have. And that is the bursting of overhyped tech bubble-based like companies, NFTs, crypto, SPAC stocks, all of that stuff, and that kind of fall in line with a lot of the tech companies, right? And I think that's the exact correction we're seeing, very similar, and we're only seeing interest rates just get back to those 2008, 2009 levels, and we're obviously seeing the pretty much the end of the interest rate hike cycle, which also makes me come to think that we are seeing the end of the crazy calamity bubble burst that we just witnessed in, again, overhyped stocks. We're going through the crash right now, just like through 2008 when they were going through the crash. We saw this exponential job loss, where even though we're hearing about a lot of job loss, it's in very niche sectors. There's still a lot of demand in service. There's still a lot of demand in energy. There's so many places you can go and get jobs. And even if you're in a tech industry, there's still a lot of tech jobs out there. I mean, I looked it up on Indeed here where I live. There's tons of tech jobs. People are still getting hired across the board. That's why I don't think we're seeing a 2009 like event. We're seeing this .com era bubble, and that's leading up to incredible buying opportunities that even the likes of Buffett is starting to take advantage of. But getting into Berkshire Hathaway, Warren Buffett, the mogul that now sits on the top 5 of the S&P 500 is the largest companies, outpacing Meta, outpacing Tesla. Taking a look at the buys in this portfolio, we have Chevron, we have Occidental Petroleum, stocks that I don't know why Buffett wants to buy. They're so damn cyclical. Oil's already trading back below the geopolitical Russian-Ukraine event. I mean, I don't really understand it when we know, there's going to be a decline in oil usage likely over time as people switch to renewables. But nonetheless, coming down, we do see a bit of a reduction. And this is for Q3, guys, of Activision and, of course, USB Bank Corp here. But right in between, there's a little gem that he added, a $4 billion buy of Taiwan Semiconductor. TSM is the ticker, guys. Take a look at this stock, because off its recent highs, it's trading down almost 50%. And it looks like a buying opportunity of a lifetime. A PE history or PE ratio of 13, a dividend yield of 2.39. This thing has a Geiger growth rate since inception, guys, back in 1997 when they IPO'd of over 17%. Take a look at this, because not only is this company's revenues right now, if you combined all of their competitors together in the revenue, it still doesn't actually add up to how much Taiwan Semiconductor is doing. This company, obviously, if you don't know this company, guys, they're producing semiconductors for chips, chip manufacturing, things of that nature, and they are a true monopoly, a conglomerate in this industry. Their whole subsidiaries, the entire company, makes up like 60 or 70% of the entire industry. The only next best competitor is Samsung at 17%. But what's incredible here is if you're a dividend investor, payout ratio very low at 32%, and this company literally has profit margins the likes of tech companies at 42% profit margins, operating margins at 47%. The company literally hasn't missed. Look at this. And any analyst expectations for the last quarters through this very bumpy, tumultuous market hasn't missed one. And this company coming into the last 4 quarters, it was doing $438 billion in revenue back in Q4 of 2021, and today they're doing $613 billion. They have been growing quarter over quarter. Now, there's a lot of lower guidance expectations, but that lower guidance really comes in line with the current valuation. Now, if you're even a value-focused investor, I mean, you can run the math and see the value in the current balance sheet and what you're paying for this company, and they're expanding beyond, obviously, Taiwan. A lot of geopolitical events, concerns going on with China, surrounding areas, but nonetheless, guys, they're even building 2 major factories in Arizona, $40 billion production facilities here, going to hire 20,000 plus employees. My God, you're not going to go wrong here, right? So this is a very fascinating stock that I think is an incredible buying opportunity for 2023. But let's talk about overhype. Let's talk about the tech-like stocks that are getting absolutely crippled, and everyone's trying to pray to their God. Elon Musk being like, oh, this is going to be the most valued company on the planet one day. Though that may be true, it is not true in this current moment. And the stock, I still think, sustains remains an overvalued metric without self-driving, without robotics. But I want to explain to you, aside from my own personal opinions, why this stock is getting decimated, why it's going to continue to get decimated, and it all comes down to the weighting of ETFs here. Take a look at this, because whether it's VOO, SPY, you go to BlackRock, you look at any of your S&P 500 based index investments, and this is where most money goes. Trillions of dollars sit in these funds, and the problem with these funds is they're brilliant in the fact they weight stocks based off market cap, but as stocks start to de-weight in value, whether it's from insider selling, whether it's, retailers selling, that all combined triggers events that cause more selling in these ETFs here, guys, because as I put new money into, let's say, VOO, 6.47% of that immediately goes to Apple stock. However, we can see Tesla still sits on the VOO list and has slowly been de-weighted down, and right now this is going to be completely removed from the S&P top 10, because just in the last month alone, Tesla is now below ExxonMobil in market cap value. It is like, what's Tesla at? 350 billion, whereas Exxon's now over 400 billion. So as that happens, all of these ETFs are going to be selling off automatically weightings in Tesla stock, and that is what we're seeing, is this triggered sell event from all these ETFs that use unemotional mathematical systems to sell companies. I mean, this is all triggered events here, guys, and just take a look at the shifting in here. My God, Berkshire Hathaway now in the top 5 largest companies in the US. It's taken a while for them to build up to that, but now that tech's selling off, I want to talk about some of these tech stocks, the values in them, because I think honestly Tesla should kind of end up between $50 and $100 stock. I wouldn't be surprised. We've got to be patient for it. We'll see where it goes, because right now 38 PE, the lowest PE it's ever had since it started posting positive EPS. But one stock I find rather fascinating, we should discuss Google here real briefly, because Google marketing plays are going to get very hit in obviously a recessionary period, but Google right now is one of the most favorable companies, I think, on the S&P top 10. I wouldn't be surprised if Buffett starts paying attention to these kind of stocks, because just take a look at this. Right now, Google, guys, is trading at a PE of 17.72, and it's hard to wrap your head around the last time Google traded anywhere near close to that. And again, you could go back to the 2020 crash, but realistically, the last time it was in the 17s was back in 2012. The 2012, the era is so damn long ago that it's crazy to think that that's where Google's kind of refrained back to. So there's a lot of, lower guided expectations coming into the future, which is good for you as an investor, because obviously this period isn't going to last. We're going to go back into a nominalized market and eventually a bull market. It might take 1 to 3 years, but that's your opportunity to accumulate. And especially with a company like Google, guys, it's kind of staggering to think it's trading at these levels, because inevitably market spending will come back and higher growth rates will return. But let's take a look at some of the comparables like Apple here. How is Apple holding up? Well, so long as Apple posts good numbers, which they never seem to, blow my mind at how good of numbers they can post through holiday seasons. I mean, this thing is holding up, and we're not seeing really low PE multiples on it, nothing back beyond the 2020 era. So nothing cheap or discounted really there. You're looking at Microsoft here, guys, which has actually stepped back a little bit more in time, but trades at a heftier value compared to Apple, even still 25 PE, which has been its historical PE, I think, pretty much since 2018, 2019. So no discounts there. Amazon even, guys, this Amazon stock is always traded at super high values, because obviously they've never taken bottom line from e-commerce. It's all coming from their cloud service business, which currently they've been getting devastated, but nonetheless, I wouldn't even look at try and value this based off PE multiples. It wouldn't make sense. But nonetheless, folks, it's kind of crazy to think that the market we're heading into right now, I think, is going to be the buying opportunity of a generational wealth building moment. It's very unheard of to get crashes. I mean, it's like a decade in the making to see crashes come into play like this. And I don't think the real value is going to be in these crypto insanity people. I think it's in the likes of Warren Buffett buying things like Taiwan Semiconductors. I think it's going to be things like Tesla, like Google. I think these opportunities are setting up now in front of your face. And even if real estate does correct, if those speculative real estate markets come crashing down, I really hope you're not stupid and you see the reality that's facing you. And I hope you have some liquidity, or you're doing something to put yourself in a position to take advantage of this insanity. This is going to be a beautiful moment for wealth building.